You know, it's quite something when you think about it. Market bubbles. For centuries, right? I mean, we've seen these massive surges in value, things that just inflate and then pop.
Yeah, exactly.
From what, the 1600s with tulip bulbs,
Uh,
people paying more than house prices for them,
Crazy.
all the way to, well, the recent crypto roller coaster. It's definitely not new.
No, not at all. And that's kind of the fascinating part, isn't it? How these events, seemingly so different, actually share some uh, fundamental traits.
Right. So today, that's our mission, really. We're doing a deep dive into why these things form.
And what we can maybe learn from looking back.
Exactly. We'll look at some big ones: Tulip Mania, the South Sea bubble, the dot-com boom.
And then try to connect that history to what we just saw with crypto.
Okay, so let's start way back. Tulip Mania, Holland 1600s.
The classic first example.
I mean, a single tulip bulb worth more than a house. It just sounds unbelievable.
It does. And it's seen as, like you said, the first properly recorded speculative bubble.
And, well, the name Mania kind of gives it away. It wasn't going to last, right? The prices eventually just collapsed.
Right. And what Tulip Mania really shows quite vividly is how this sort of speculative fever can completely detach an asset's price from any, real underlying value.
So it wasn't even about the flower anymore.
Not really. It was almost entirely driven by this belief that, well, someone else would pay even more for it down the line. Pure momentum.
Okay. Then let's jump forward a bit. The South Sea bubble.
Ah, yes. Early 1700s Britain.
This one wasn't tulips, it was a company, right? The South Sea Company.
Correct. Shares in a company.
And you mentioned earlier it had a big impact on, like, investor psychology. It played with people's heads.
It really did.
Yeah.
That's maybe a key difference from Tulip Mania, or at least a different emphasis.
How so?
Well, the South Sea bubble really threw a spotlight on just how powerful psychology and herd behavior can be in these market frenzies.
The fear of missing out. FOMO.
Exactly. That collective excitement, the feeling that everyone else is getting rich and you're being left behind, it became a huge driver. People made investment decisions based on emotion, not, a cool-headed look at the company's actual prospects.
Which probably weren't that great.
Fundamentally, no.
Yeah.
Not enough to justify the frenzy.
Okay, fast forward again. Dot-com bubble, late 90s, early 2000s. This one feels more recent. Many of us probably remember.
Definitely. All those new internet companies, IPOs happening constantly.
Yeah, crazy high valuations for companies that maybe weren't even making money yet, and then pop again.
Indeed. But the dot-com bust, perhaps because it was so recent and involved technology we now use daily, left some pretty clear lessons, I think.
Such as?
Well, it really hammered home the difference between a compelling story,
Yeah.
a vision,
Yeah.
and an actual viable business. Potential is great, but without a clear path to making money to sustainable revenue, these extreme valuations just aren't sound.
So the narrative, the new economy idea, maybe overshadowed basic business sense.
I think that's fair to say. The hype around this changes everything fueled massive speculation, sometimes ignoring those fundamentals.
Which brings us right up to the very recent crypto boom and bust. It's really hard not to see the parallels with those earlier bubbles we talked about, isn't it?
It really is, yeah.
The super fast price surges, the intense hype everywhere, online, offline, that fear of missing out again. It all feels very, very familiar.
Precisely. When you connect the crypto experience back to Tulip Mania, the South Sea bubble, the dot-com crash,
Yeah.
you see these repeating patterns emerge.
Like what?
Like the allure of getting rich quick, that almost magnetic pull, the way price can detach from any sort of measurable intrinsic value, and then the almost inevitable correction or crash.
So the asset changes, flowers, stocks, digital tokens, but the human behavior.
The underlying human responses, the psychology driving it, yeah, that often seems remarkably consistent across centuries.
So looking back at all this 17th century flowers, 18th century stocks, dot-coms, digital tokens, these boom and bust cycles just seem baked into market history.
It seems that way,
Sure.
driven by some pretty fundamental aspects of human behavior and market dynamics.
So what's the takeaway for you listening now?
I think this historical view really underlines why it's always important to, think critically, to understand a bit about market psychology.
Yeah.
Recognizing these patterns we've seen again and again. It doesn't mean you can predict the future, of course not, but it can maybe give you a more informed way to think about things, to navigate whatever the market throws up next.
That makes sense. And actually, thinking about how markets keep changing, Our next deep dive is going to tackle a really major force shaping trading right now.
Oh, yeah. What's that?
The rise of algorithmic trading, algos, high frequency trading,
Uh-huh.
how that's transforming everything.
Ah, okay. That's a big one. Definitely transformative.
It is. So make sure you join us for that exploration next time.